Do you want to take advantage of your ISA allowance but simply don't have the spare cash? It's such a shame to lose the chance to save £20,000 tax-free each and every year. You might think that it's not possible to save your tax allowances for future years and that if you don't use it, you lose it, right? Well, maybe there is a way. My name's Justin King. I'm a chartered and certified financial planner. I help people retire successfully. In this video, I'm going to explain how to use a combination of flexible ISAs and an offset mortgage to plan tax efficiently for your future. If you're likely to come into some money later on in life, maybe an inheritance or your tax-free cash from your pension, or perhaps you'll sell an asset like a second home, this idea could enable you to save or invest it tax efficiently. So let me start by explaining how flexible ISAs work. Flexible ISAs enable you to withdraw money from your ISA without it affecting your allowances, as long as you put it back in the same tax year. In this case, it's treated as not having been withdrawn at all. Flexible ISAs are helpful if you think you might need access to your savings at some point during the tax year, so you can dip in and borrow the money back and then repay it back in to the ISA before the 5th of April. Taking this idea to the extreme, you could transfer £20,000 into your ISA on the 5th of April, the final day of the tax year, and literally withdraw the money on the morning of the 6th of April, the first day of the new tax year, just 24 hours later. As long as it's back in the ISA again by the evening of the 5th of April the following year, 364 days later, you're in the clear because you've returned it in the same tax year. Of course, the next day you can take it back out for nearly a whole year again. Now, this might sound like a shifty thing to do, but be assured that this is a legitimate tax planning opportunity you can take full advantage of. Let's see what this looks like if you repeated this cycle each year for 10 years. So this table shows what your ISA balance would be on the final day of a tax year, assuming you contributed £20,000 each year, and what the balance would be on the first day of the next tax year, assuming you withdraw all your ISA funds. In year one, you would have £20,000 in your ISA, which you'd then withdraw at the start of the next year, so the balance in your ISA would be zero. By contributing an additional £20,000 on the 5th of April of the next tax year, you would also need to put in previous year's subscriptions back into your flexible ISA, and then withdrawing the lot the following day, your ISA allowance grows by £20,000 a year. In 10 years, you would have an ISA allowance of £200,000. Assuming you receive zero interest, of course, as the money wouldn't be in the account long enough to accumulate any interest. And remember, you only need to borrow the money for one night every year, overnight between the 5th and the 6th of April. So with this plan, you can see how you could create a £200,000 tax-free haven in your ISA within 10 years, ready and waiting for when you come into that windfall or sell an asset. But where will you find £20,000 each year to make these annual contributions? The answer is an offset mortgage. If you have an offset mortgage or a flexible mortgage, which is one that enables you to overpay and redraw the funds at will, then you're all set. You're simply going to draw the money down on the 5th, warehouse it in your flexible ISA overnight, and then pay it back or offset into the mortgage with the other 364 days of the year. It's going to cost you just a few days' interest. You might need to start off by taking out possibly a larger mortgage than you otherwise require in order to give yourself the borrowing capacity to fill your ISA. But since it's an offset flexible mortgage, you can do that and pay no more interest, since the extra cash you will spend most of the time parked against your outstanding balance. There are two reasons why this makes sense. Number one, it's a completely reversible transaction. It's not like contributing to your pension, for example, where the money is then locked away. You can stop at any time if you need to and let your ISA allowance lapse. Number two, it's a very low cost option. you simply lose a few days interest on your offset savings. If you enjoyed this video, please press the subscribe button below the video now for more help planning a successful retirement. And if making tax-free savings into an ISA is important to you, you might enjoy this video here. See you soon.